we work with you guys on your 401k, your retirement plan. A lot of you look very familiar. There are some new faces. So I'm here to talk about some changes that we are making to the retirement plan and why we're making those, or why we've made those changes. I also have a sign-up sheet here for individuals that wanted to meet afterwards. If you decide after the meeting or during the meeting that you want an opportunity, it's not too late. And also, I'm always available via the telephone, and our offices are just down the street near your old offices, so that we can schedule an impromptu meeting either here or in my office. I want to start off by talking about the notice that you should have all received, talking about the changes that we're making in the plan. It looks like we're making a lot of changes. You'll notice, though, that some of these funds look relatively the same. Like, for example, the Vanguard Total Stock Market Index. We're going to the Vanguard Total Stock Market Index. You'll notice that there's a slight difference in what they call the ticker symbol. And what we're taking this opportunity to do, as long as we're making changes, Vanguard has come out with a better share class, which means a lower expense ratio. So we were able to take advantage of that at this moment in time. So what that means to you is that if the Vanguard Total Stock Market Index returns 10% net of expenses in this fund, you might get a shade over 10% net of expenses because they're the same underlying fund with lower expenses. Okay. We're also taking this opportunity to update the plan where we had it. Historically, I've been acting as the broker of record on your plan, and this is somewhat semantics, but I do get paid for my services, and historically I was being paid by the mutual fund companies directly. So the expense ratios in the funds were higher to afford payment to me. What we've done is we've gone to a more transparent fund, which is lower expense ratioed funds, and my fee that I will be receiving will be paid from the plan assets. So and you'll be able to see it, and I'm going to show you what that expense is moving forward. The nice thing about this is that it's more transparent, number one, and number two, when we put this plan in place, it was a much smaller plan than it is today. And as the plan grows, it's much easier for me to renegotiate the fee that I'm taking from the plan. As the plan grows, I don't need to have as much. The percentage of the assets that I'm charging should go down. Where the old way of doing it, the mutual fund company says this is what we're paying you by contract, and there was no negotiation. So overall, the expenses in the program should have dropped and should continue to drop. We also made some, and I'm not going to go through every single fund, but we made some changes in the target retirement date funds, and we've also streamlined or removed some of the lifestyle funds that originated in the plan. And what that means is these are pretty much pre-made portfolios, so that you can choose a fund and know that you're very well diversified and allocated. What we're doing is we're just streamlining those. We're taking away the lifestyle, and we're increasing the number of target date funds. And so what you simply can do, if you're concerned about what your asset allocation is, am I too aggressively invested, too conservatively invested, you can say, you know what, I'm going to pick the target 2030 fund because that's on or around the time I plan on retiring, and know that you have a good asset allocation currently, and as you get closer to that date, that fund will become more conservatively invested so that when you when you need less volatility, when you're getting ready to use those dollars, you will see less volatility. There's still market fluctuation, and less is not always none. So it'll be less volatility, but there will still be volatility as you getting closer to that date and beyond. We do have one fund that we had to maintain that we really wanted to get rid of, and that was the Galliard Stable Value Fund. And the reason why we have to maintain that is by contract with that vendor, they require us to maintain that fund in the plan for 12 months after getting rid of it. And the reason for that is it's a stable value fund, and they're promising to pay a stated rate of return, and they are not necessarily investing it in a money market type of a vehicle. They're investing in bonds that may be staggered in terms of when they come due. And the only way to assure that they can pay us or pay the plan, the participants, a stated rate is to manage their portfolio in such a way that they can free up some cash to pay out or to liquidate our positions. We did replace that fund on a moving forward basis, so any new monies that are going into that fund is actually closed off. And actually the good news is, I believe on last Thursday or Friday, after this material that I'm going to be handing out was printed, the last participant's dollars. At the participant level, you could always have chosen to move your money out. At the advisor or at the plan sponsor level, you could not do that. The last participant removed their money from that fund and went into the new stable value fund that we're offering. The reason why we are offering a new stable value fund is because the promised rate of return was a little bit higher. So this material, as we're sitting here, is a little bit outdated. The Galliard Stable Value Fund, we're not going to be, it's a moot point. It's closed down for all practical purposes. No new money will be able to go in or come out of that fund. You also had a listing of the fund expense, the funds and the underlying returns and expenses that were attached. I'm not going to go through that today. You can find on the website the new expenses and the new returns. And as I pointed out, we were in the I will point this out, we were in the R3 share class for example, on the American funds. We're now in what's called the R6 share class. And that's stripping out some of those expenses that we talked about earlier. So this is the enrollment form. One point I want to encourage here, it's pretty straightforward. If you are in the plan already, there's nothing you need to do, but it's a great opportunity to update your election. Your name, social security number, and my recommendation is to, if you're going to make an election update or change, is to really think about switching your, if you're doing a dollar amount per paycheck, I encourage you to go to a percentage of pay. I think it's a more straightforward way to contribute to a retirement plan. As your income goes up, goes down, it changes, so does your contribution. So if you are lucky enough, if we're all lucky enough to get a pay increase at some point in time, you are going to continue to increase the amount you're putting into your retirement account, which I think is really positive, and most of us are behind the curve on trying to save for retirement. So that's a way to help you get to where we need to be. The default investments in the fund, in the plan, have changed. They were the prior target date funds. There were fewer of them. We now have a full suite going from target date retirement age of date of 2015 to 2060 in 5-year increments. And if you don't make an investment election in the plan, you're going to go into one of these funds. And based on your date of birth. I want to point out also, just to make sure that we're all clear, we did have a fund in the plan, and that was actually the default investment election, I believe, the United Diversified Fund. We decided that it was, while it was really cool to have a fund that was representative of the organization, and it was very well, I think, received and used in the plan. We, the trustees and myself, we decided it was time to eliminate that fund, not because it wasn't a great mix of funds and it did well over the course of time, but the reason why we decided to get out of it, people we felt were not necessarily remembering or ever even really knowing what they were getting into in that fund. Was it a conservative fund? Was it a more aggressive fund? And there were some people we felt thought that they thought that was, because that was the default, that was the most conservative fund in the plan, and it was not. But you know, over time it did perform well, and as long as we stuck with it through the down times, we all did well. Anyways, so we decided to remove those funds. If you were in those funds, we did map them to whatever the underlying funds were, so you still are holding that same allocation, it's just showing the underlying funds now. Does that make sense to everybody?
Adam, are you referencing the United University?
Diversified, yes. Yes. Yeah, so there might have been, let's say there were 4 funds in there. There was the A fund, the B fund, the C fund, and the D fund. And they were 25% in each of those funds inside the model. What we did is we just mapped from the model 25% into the A fund, 25% into the B fund, 25 into the C, and 25 into the D. So you have the same position. And keep in mind, there's no charge for this. You can switch around your investments as often as you'd like. We recommend that you don't do it too often, but this is a great opportunity to evaluate what you have and make sure that you're not taking on too much risk or too little risk for your investment style.
How would you rate that fund? The United, was it an aggressive?
It was leaning towards the aggressive side, yes. Okay. It was a more aggressive fund. Okay. And that was one of the concerns that we had, is that people didn't recognize that it was more aggressive. Okay. They thought it was a more conservative strategy.
So if you selected that, you would recommend really evaluating your participation in that, or how it's been remapped?
Absolutely. Well, I recommend, regardless of what your asset allocation was or how you determine it, it's always, now is a great time. There are some new funds. It's a great time to reevaluate. Okay. And you might have been, some of you have been in the plan for a number of years. And if you are like most participants in the country, you set it and you forget it. So it's really a good time to evaluate and say, am I the same type of investor I was? It might have been the perfect choice for you 5-6 years ago, but today you might be in a different place.
So the funds that you guys moved it over to, is it still aggressive?
Oh yeah, it's just because remember I said in my example we just mapped from inside the fund, inside the portfolio, to outside, so it's the same underlying funds that you're invested in.
Okay.
Okay.
Adam, isn't there a charge for some funds to switch them over?
No. No? There's no charge for changing of funds. You can go. I started to say that. Thank you for bringing it back up. No, it was. Thank you. I got lost track. There are no charges to going in or out of a fund. Okay. There are some of the funds that may have limitations as to when and how often you can come in and out of the funds. Okay. And what we do we try on our website to show you what the limitations are. For example, American funds will allow you to go in and out of a fund, but they say if you move from the American funds, Growth Fund of America, or the, it doesn't matter what fund, target date 2025 fund, they will not allow you to go back into that fund right away. I believe it's a 30-day period. So you can go into another American funds, let's say the target 2020 or 2030, but you just can't go back into that same fund for a 30-day period. And it'll be outlined, there's a little green dollar sign that you can click on, and it gives you an explanation as to what the limitation is. And there are some fund companies, and actually some funds, do charge what's called it's a surrender charge. If you don't hold a position, some of them in that dollar sign will explain to you saying if you haven't held this position for 7 days or 30 days, there's going to be a 1% deferred sales charge on it. That might be what you were referring to.
Well, I thought there was like some class A funds, or what am I thinking about?
No, okay,
You know
so,
what I mean?
yeah, so let me finish up on this topic. If
Yeah.
in the green dollar sign, there are some funds that potentially, and I don't know if there are, to be honest with you, any that fit this requirement. The only one that comes to mind is the American funds. And that's not there's no penalty, it's just you can't go back into it. But some of them might say you have a 1% deferred sales charge if you don't wait the 30 days. And our system will calculate and try to tell you, give you an estimate as to what that expense is. My feeling is, don't pay the expense, wait, there's inside a retirement fund, there should be no urgency to move in and out of funds. This is a long-term investment, we're not day trading. We believe that you should make an investment election, and let's say we're doing it today, you shouldn't be thinking about changing it in 7 days or in 30 days. You should be looking and seeing how it's doing over 6 months, a year, 3 years, and so on. So I would try, unless there's a critical reason you made a mistake and we have to exchange out, and you're concerned, give me a call, but I would say in most cases that should not affect anybody in the room. The A-share issue, historically A-shares have charged a front-end load of, it could be any percentage, but the most typical one that I can think of is 5.75% of the money you put into the plan. This retirement, because you're in this retirement plan, that has always been waived. There's no charge to get in or out of a fund. So,
Thanks.
but if you're buying it in your own IRA or personally, you probably are going to be subject to that load. Any questions, by the way? If anybody has any questions, keep asking away. It makes
sign-in sheet?
sure.
Where's my sign? Oh, for the, yeah.
So this will be available, it should be available on the website for you. This is the most recent fee disclosure document. And a lot of it is just telling you how to access information, where to get information from, and what I want to focus in on are these charts. These are the fees that are going to be charged to your account. There's the investment advisory fee that we talked about earlier, where the fund company used to pay me directly. Now the plan is going to pay me is 25 basis points, which is 1/4%, and 25% of that will be paid each quarter. So you'll see that coming out of your account on a quarterly basis. There's a record-keeping fee, and that's maintaining the systems and the technology and supporting your transactions and trades. That's a flat, well, it's 13 basis points, which is slightly more than 0.1%. That number does decrease as the assets continue to grow. And then there's a custodial charge of 4 basis points. To give you an idea, on a $10,000 account, this is what the charge is, the $42, which is 42 basis points. There is some revenue that the fund company would pay somebody to do some of the record keeping and some of the maintenance on the account, and that's being credited back to your account. And this is just an estimate of what the amounts are. That number fluctuates based upon the actual underlying funds you happen to be investing in and the dollars that are invested in the plan. There are a few other charges that you may run into. If you're taking any kind of a distribution, if you're a loan fee of $100, the overnight and stop payments, those typically don't occur. The one fee I want to focus in on here, which is not a large fee, but it's a $1.85 per quarter for hard copy participant statements. The reason I want to point that out is you can eliminate that fee. We had sent out some documentation to you, I think it was towards the end of last year, explaining to you that this fee is going to now be instituted, and there is a way of eliminating it. You can go online and accept electronic participant statements, and by the way, you'll also be notified of new disclosure notices, etc., that become available to you electronically. But that's a way to eliminate the $1.85 charge to your account. You'll have access to electronic statements. You'll be notified by email. We need a good email address for you. And then you can go out on our site and print up the same statements that you had before. This is a listing of all of the funds and their historical returns. Again, these are your stable value funds. The Wells Fargo fund is the one that's going away. And as you can see, both of these funds have the same comparison, U.S. Treasury maturity of 3 years. That's the same. They're comparing themselves to the same, I guess, index. But you can see that the historical returns on the stable value fund have outperformed the Wells Fargo fund. So we decided as a group to make that change. I'm not going to go through all of these funds, but you can, as we talked about, you can build your own individual portfolios on the website, or you can select one of the target date funds, and that will assure you that your strategy will continue to get more conservative as you get closer to retirement. I encourage you, if you're going to build your own portfolio, to take a look at the rebalance feature that's available on the website. It allows you to rebalance your portfolio as often as you like. Again, there are no charges for doing so. My recommendation is you don't have to do overkill there. Once a year is probably plenty in terms of rebalancing.
Adam, you want to describe what rebalancing is?
Thank you. Yes. Rebalancing basically is if you've chosen to be invested in two funds, a stock fund and a bond fund, and you said I'm a 50-50 investor. I put 50% of my money in the stock fund and 50% in the bond fund. What happens over time? We hope the stock market goes up, right? And it goes up at a better rate, or maybe bonds actually are going to decrease a little bit. So we're 50-50 and we've got our money going in half and half, right? But over time, if the stock market is outperforming, what happens? We might wind up being 60-40 or 70-30. And what have we done? Let's say 50-50 is a moderate investor. 70-30 is approaching, it is an aggressive investor. So you've, over time, you haven't done anything differently, but you become much more accepting of risk, right? But you didn't really plan on doing that. So if you say I'm going to rebalance my portfolio, whether it needs it or not, every September 29th or 28th, what you're doing is you're selling off of whichever of those funds has done better, and you're buying into the fund that has not performed as well. So you're snapping yourself back to 50-50. So what does that, what effect has that done to you? It's gotten you back to that same level of risk that you had accepted initially when you signed on. But it also says, I'm going to sell high, right? And I'm going to buy low. That's one of the I guess, most important things that you hear about when you're trying to invest. You want to buy low and sell high, right? And that's exactly what we're doing. Okay. Thank you for that. If I gloss over something like that again, please let me know. So I think that is all I wanted to show you. Well, the other reason we switched out of, as I pointed out, we switched out of these funds. Down at the bottom of this disclosure notice, it shows you the expense of the fund and the expense per $1,000. You can see the Wells Fargo fund had 105 basis points, and now it's down to 62. Okay, now it's not all savings, remember, because we do have that 25 basis point additional fee that's coming out of your account. But to apples, if you had 62, if you had 25 onto the 62, you're at 87 versus 105. So the expense ratio of the fund is lower. And by the way, more importantly, the net return was better too. So if you look at all these funds, you're going to see that the American funds are 6 funds. The expense ratios have gone down compared to the R3 that we had. The Vanguard index is down to 5 basis points, and I'm guessing that, I don't recall what it was probably 15 or 20 basis points. So we have reduced the overall expenses of the plan. I think that's really all I wanted to talk about. I do have some handouts for you, which is basically what we just talked about. But again, this information is available on the website at my-pension.com. And you'll need, if you've not been on the system, you need your Social Security number, which is the user ID. The password is the last 4 digits of your Social Security number. If you've been on there and you forgot what you changed your password to, or your user ID, there is a little help button on the main screen. But you can also always call our office, and we can help you out as well.
Hey, Adam, who are the trustees?
Nancy, are you out there? Could you help me out with that? It's Bruce?
Bruce and Jeff Johnson.
Okay. Thank you. Any other questions? Anybody else want to sign up? Go right ahead. I'll be here as long as you guys need me today. Nancy, did you want to hit anything more on, I know that there was a concern about the percentage versus dollar amount. Did I hit that sufficiently?
You did. So
Okay.
just as a reminder, for those people that defer a dollar amount per check versus a percentage, any supplemental payments, bonus, commission, whatever, you're only deferring that flat dollar amount. So think about when you are planning for retirement and savings, if you defer a percentage, it's going to be a percentage of your bonus in addition to a percentage of your regular pay. So it does behoove you.
And how much is the company matching rate?
The company matches dollar for dollar the first 3% deferred, and then 50% on the dollar for the next 2%. So essentially, you defer 5%, the company matches 4%. You're always 100% vested in the employee match on your 401k deferral. But the profit sharing has a 6-year vesting schedule. And it vests 20% year 2 and 20% every year thereafter till 100%.
Can one of you address the issue of how much more we can contribute once we pass 59? I understand that there's a plateau there.
Actually, once you hit age 50, you can, the 401k limitation for this year is $18,000. And once you hit age 50, you can do an additional $6,000
Per year,
per year. So you could do a total of $24,000.
and that's without any penalty from the
Right.
government.
Correct. That's allowed, but you have to be 50 to do
Okay,
it.
got it.
You have to turn 50 before the close of the year.
And the
Calendar year.
system will automatically allow that. So we had one person, for example, who had not yet turned 50, but would be 50 this year, who deferred as much as possible from the first couple of checks and received a bonus payment, and then maxed out at the additional 6. So. Anything else? Any questions?
So thanks to John
You know how-
Bruce
what-
for the review and the savings. No.
Where do we find out what our current deferment is?
So you can log into the ADP system,
It's on the
myself, look at your deductions,
Okay.
and you'll see how much you're deferring.
And for, I do have some enrollment forms if anybody wants to update it. This, by the way, is available, they're available online as well, under the forms and reports section of the website. And then I also have some almost current fee disclosure on the funds.
And as a reminder, for those people who were bought out of stocks this year, you may really want to spend some time with Adam and talk about your investment strategy and mix and see what is best for you now.
Oh, I got a question. Now it says what your estimated portfolio will look like at retirement age. How accurate is that?
You know what, there are, you know, there are, are you talking about on the participant statements?
Yeah.
Well, there are, as you can see, there are only, it's a very rudimentary calculation. There are only 3 or 4 things that it's looking at. It's looking at what your current balance is. It's looking at the, it's supposing that you're going to get, I think 6% return on your money prior to retirement, 4% post. Don't quote me on that. I'm going from memory here.
Yeah.
And then it's also taking the contributions that you made during that period of time, that quarter, and it's assuming that you're making that same contribution or allocation each quarter. So you may have some quarters that are one quarter in particular that may be skewed. For example, if there are employer contributions coming into the plan that only hit once a year, it's going to look like from going from the prior quarter to the next quarter, it looks like your account has exploded and it's going to grow much faster, and that's just because it's a very basic calculation. It's not perfect.